A few years ago, I sold Bitcoin to buy a car. I didn't want to, and I remember staring at my Bitcoin wallet thinking there has to be another way, but I needed the car, I needed the cash, and so I hit sell. That Bitcoin is worth around $300,000 today, and the car, I don't even own it anymore. It depreciated to basically nothing, while the asset I gave up for it went vertical. Almost every Bitcoiner I know has a version of this story: the house deposit, the tax bill, the emergency. That moment where you're staring at your stack thinking, do I really have to sell this? Well, there's a financial tool that exists specifically for that moment. It's called a Bitcoin-backed loan. You keep your Bitcoin, you lock it up as collateral, and you borrow cash against it. Sounds great, right? But it comes with real risks. Risks that, if you don't understand them, can cost you your entire stack. So this video is exactly what the title says: an honest guide to Bitcoin-backed lending, how it works, why people use it, when it makes sense, when it absolutely doesn't make sense, and how a platform like Firefish, who I'm happy to have as a sponsor for my podcast, solved this problem in a very unique way. So no hype, no infinite money glitch, just the full picture so you can decide for yourself. All right, let's get into it. So, what is a Bitcoin-backed loan? Let me put it this way. It kind of works like a mortgage, but in reverse of how you would normally think about it. With a mortgage, the house is the collateral for the loan you use to buy it. With a Bitcoin-backed loan, your Bitcoin is the collateral and you get cash out. You lock up, say, 20,000 euros worth of Bitcoin and you borrow 10,000 euros against it. You pay interest, and at the end of the term, you repay back the loan and you get your Bitcoin back, including all the upside it captured while it was locked up. Now, why is this idea so attractive to Bitcoiners specifically? Because of what we believe about the two assets involved, right? Bitcoin, over a long enough time horizon, appreciates. It's the hardest money ever created. Fiat currency is designed to do the opposite. It loses purchasing power year after year forever. So borrowing a melting asset against a hardening one feels almost like cheating. And if you play that logic forward, you get what is called a rollover. And it goes like this. Imagine Bitcoin is at $10,000 and you own one Bitcoin. You need cash, so you lock up your Bitcoin and you borrow $5,000 against it. Only half of the value because you want a safety cushion. Years pass, now Bitcoin runs up to $100,000. Your collateral is now worth 10 times more. So you take a new loan, let's say $50,000, and you use a slice of it to close out the old one and you pocket the difference. Bitcoin hits higher levels again, and then you repeat. So in theory, you never sell, you never realize a gain, and you have access to liquidity forever. That's the theory. And look, the logic isn't crazy, but this is where the honest part of the guide comes in. This is not free money. You pay interest on every one of those loans. On Firefish's open marketplace, rates are set by supply and demand, and they typically land somewhere between 5 and 15% a year, depending on the amount, the duration, and the currency. So for the math to work, your Bitcoin has to outperform your interest rate. Historically, over 4-year windows, it has comfortably, but it does not do that in a straight line, and that volatility is exactly where people get hurt. So hold that thought because we're going to come back to it. But first, let's talk about why people would even use these types of loans at all. There are 3 honest, concrete advantages to borrowing against your Bitcoin instead of selling it. Number 1, selling triggers taxes. Borrowing usually doesn't. When you sell Bitcoin at a profit, most countries treat that as a taxable event. Depending on where you live, a serious chunk of your gains goes straight to the tax office. A loan is different. Loan proceeds are debt, not income, and in most jurisdictions, debt isn't taxed, so the full amount lands in your pocket. Now, of course, tax rules are different in every country, and some places tax Bitcoin gains heavily, some barely at all, and the rules keep changing. So before you build any strategy around this, understand exactly how it works where you live. But the general principle stands: borrowing lets you access the value of your Bitcoin without realizing the gain. 2. There's no credit checks, no paperwork, no bank deciding if you qualify. Think about what a bank wants before giving you a personal loan. Salary slips, tax returns, credit history, your whole financial life on the table, and then they decide. A Bitcoin-backed loan flips that model completely. The loan is fully secured by the collateral, so nobody needs to judge your credit worthiness. You hold Bitcoin, you qualify. That's it. It's an open, permissionless credit market, and comparing it to a bank application makes the latter feel absurd. 3. There's no monthly payments. This one surprises a lot of people. With most Bitcoin-backed loans, including how Firefish structures them, you don't pay monthly installments. You repay the principal plus interest in one payment at the end of the term. Your monthly cash flow stays completely untouched for the entire duration. So, no taxable event, no gatekeepers, no monthly drag. You can see why this product exists. Here's what most people get wrong about Bitcoin-backed loans. They hear, keep your Bitcoin and get cash. And their very next thought is, wait, what if I use that cash to buy more Bitcoin? That is leverage. And I want to be very transparent about this because some people genuinely do this, and pretending it doesn't exist wouldn't be honest. So the logic is very seductive, right? You're convinced Bitcoin goes up over time, so borrowing at 10% to buy an asset you believe compounds at 40 or 50% feels like obvious math. And in a bull market, it also works. Every leverage position looks like a genius when the line goes up. The problem is what happens when it goes down. And it always, at some point, goes down. I mean, look at $63,000 at time of the recording of this video, when we were at $126,000 just a few months ago. So say you have one Bitcoin worth $100,000. You look it up, you borrow $50,000 and buy half a Bitcoin more. Now Bitcoin drops 40%. Your collateral is shrinking toward your liquidation threshold, so you need to top it up. But with what? The half Bitcoin that you bought? That also dropped 40%. It's now worth $30,000, not the $50,000 you paid. So you're underwater on the new position and your original stack is at risk. And that's the leverage spiral. Every layer of leverage multiplies your liquidation risk, and drawdowns of 40, 50, and even 70% are not rare events in Bitcoin. So let me be clear about where I stand. This is not something that I do, and it's not something I'd recommend. Some experienced people run this play with strict rules, tiny loan-to-value ratios, and reserves ready to deploy, and that's their game. For everyone else, borrowing against your Bitcoin to buy more Bitcoin turns a useful tool into a casino where the house edge is your own impatience. The honest use case is much more boring and much more powerful, and we'll get there. But first, you need to understand liquidation itself, because even careful borrowers face this risk. So even if you never touch leverage, even if you use the loan for a car or a tax bill or a renovation, there's one risk you carry for the entire duration of the loan, which is liquidation. When you open a loan, you can borrow up to 50% of your collateral's value. So 10,000 euros in Bitcoin locked gets you a maximum of 5,000 euros in cash. That 2-to-1 cushion exists precisely because Bitcoin is volatile. Your loan health is measured by the loan-to-value ratio, or LTV, loan amount divided by the collateral value. When Bitcoin's price drops, your collateral shrinks and your LTV climbs. If it climbs too far, the system liquidates. Your Bitcoin gets sold to make the investor whole, plus a small buffer to cover costs, and whatever's left comes back to you. But your stack, or a big part of it, is gone at the worst possible price, by the way, because liquidations happen in crashes. Now, the good news is that this doesn't happen by surprise. Firefish sends you margin call warnings as your LTV deteriorates, 3 of them, before liquidation triggers at the far end of the scale. At each warning, you have a choice. You can top up your collateral with more Bitcoin to push your LTV down, or repay part of the loan. Which brings me to the real discipline rule of Bitcoin-backed borrowing. Never lock up your last set. If all your Bitcoin is sitting as collateral for a loan and the market drops 45%, you have nothing to defend your position with. You're just a spectator watching your own liquidation approach. So you should keep a reserve and borrow conservatively, well below the maximum LTV if you can. Boring is the way to go here. And one more observation is the deeper reason people get liquidated is usually not the market. It's that they borrowed more than they could repay from their normal income and then needed the market to save them. Which brings us to the most important mental model of this entire video. Remember the rollover theory from the beginning. You borrow, you let Bitcoin appreciate, you refinance, you repeat forever, never sell and never repay. Here's the problem with that, and that is time. Bitcoin moves in cycles, and historically, if you held Bitcoin through any 4-year window, you came out ahead every single time. 4 years has been the magic number, so for the rollover theory to be safe, you'd want loans that run at least that long. Now, look at the actual market. Firefish offers loan terms from 3 to 24 months, which means a loan can start at a cycle top and mature in the middle of a bear market, with your collateral down 60% and your repayment due in full. The rollover theory quietly assumes you can always refinance at a higher price, but reality doesn't sign that contract. So here's how I think about how you should see a Bitcoin-backed loan. It's not an exit from ever paying anything back, I see it as a bridge. It's a bridge between today when you need cash and a known point in the future when you'll have it. You know a bonus is coming next quarter, you're a business owner waiting on a big invoice, you're selling a property and the closing is months away. You need liquidity now and you know exactly where the repayment will come from, and it's not Bitcoin will be higher. That, I think, is the healthy use case. The repayment plan lives in your income. In fiat, you can already see coming. So Bitcoin's price during the loan becomes almost irrelevant because you manage the LTV, you repay from your own cash flow, and you get every set back. That's what I'd wish I'd understood when I bought the car. I didn't need to exit my position, I needed a bridge across a few months of cash flow. Instead, I paid for that car with what became a shit ton of money. And I also want to zoom out for a second. Long term, I want us to actually use Bitcoin. I do business in Bitcoin, I spend Bitcoin. That's the end game, a Bitcoin economy. But I kind of see that we're in a transition period, right? There are moments where spending Bitcoin feels wrong because you're giving up the hardest asset you'll ever own for a depreciating one. For exactly those moments in exactly this transition, a bridge loan against your stack is a genuinely useful tool. Okay, so say this tool makes sense for your situation. Now comes the question that should be tattooed on every Bitcoiner's forearm. Who's holding your Bitcoin while the loan runs? Because we've seen this movie before: Celsius, BlockFi, Voyager. Centralized lenders that said, send us your Bitcoin and just trust me, bro. And a lot of people did, and the companies took that Bitcoin and lent it out again to hedge funds, rehypothecation, stacking risk on top of your collateral without you ever knowing. And then when the market turned, they collapsed and the users lost everything. Not because Bitcoin failed, but because the custody failed. And this is where I genuinely think Firefish is fundamentally different. And honestly, also the reason why I'm comfortable having them as a sponsor for my podcast. Because Firefish is not a lender. They are not a bank. They don't have a balance sheet full of your coins. They are a peer-to-peer marketplace, but for Bitcoin-backed loans. Borrowers post requests, amount, duration, interest rates, and investors fund the ones that they like. And Firefish built the protocol that connects the two sides. And the crucial part here is that this open source protocol is designed so Firefish never touches your Bitcoin. When your loan gets matched, your Bitcoin goes into a multi-sig escrow contract directly on the Bitcoin blockchain. Not a sidechain, not a wrapped token, but native Bitcoin in a dedicated address created just for this loan. Your collateral is never pooled, never lent out, and never reused. The escrow is built from pre-signed transactions, meaning every possible outcome of your loan is already written and locked before the loan even begins. And there are only 3 scenarios it can end. Scenario 1 is you repay. Loan plus the interest at the end of the term. The escrow releases your Bitcoin back to your wallet, and that's it. Scenario 2 is you default. The term expires and the money never arrives. The escrow releases the collateral to the investor who funded your loan. Now, scenario 3, liquidation. The market crashes hard. Your LTV blows past your threshold. You don't top up after margin calls. So the collateral gets liquidated. The investor is made whole plus that small buffer, and any remainder returns to you. Now notice what's missing from every one of those scenarios. Firefish itself. They're never a destination for your coins. They cannot decide to liquidate you on a whim, and they cannot reinvest your collateral. And if the company disappeared tomorrow, the escrow on the blockchain wouldn't care. Now, a quick note before we wrap up, because a marketplace has 2 sides. Everything we covered was the borrower's view, but on Firefish, you can also show up as the investor, the one funding these loans. You lend euros or other supported currencies, you earn the interest, and your position is secured by Bitcoin collateral worth double the loan locked in that same on-chain escrow. So either you get repaid with a yield that beats most fixed income products, or in a default, you receive Bitcoin at what amounts to a steep discount. All right, let's wrap it up. A Bitcoin-backed loan is a real tool. It lets you cross a cash flow gap without selling the best savings technology ever invented, without triggering taxes, without a bank's permission, and without monthly payments. But it's a tool with edges. So here are the rules one more time. Borrow only what your regular income can repay, not what a price target can repay. Stay well below your maximum loan to value and keep reserve Bitcoin outside the escrow so you can answer a margin call. And be very, very honest with yourself about the leverage game, because the market will not be. Remember, it's a bridge, not an exit. If you want to see what this looks like in practice, you can head over to firefish.io. The platform hides all the multi-sig complexity behind a genuinely simple flow. You sign up, you verify, you post your loan request with the amount, duration, and the rate you want, and investors take it from there. The fee Firefish earns is a 1.5% origination fee per year on the loan amount. But if you use code BRAM on your first loan, you get 30% off that fee. The link for that offer is in the description below. Please subscribe to my channel for more Bitcoin podcasts and education. And also be honest with yourself, manage your risk, and protect your stack. I hope you found this video valuable. I'll see you on the next one.